Hey guys, welcome to our first lesson. In this lesson, we're going to be discussing bank reconciliations. This is for the purposes of grade 12. So I do expect that you have a bit of a foundation before you jump into this video. So the learning objectives of this lesson are, the first one is understand why the bank account balance in the general ledger may differ from the balance in the bank statement. The second learning objective is to be able to read and understand the bank statement. And the third learning objective is to understand the need for reconciling the bank account. And last but not least is to be able to complete a bank reconciliation statement. So the need to do bank reconciliation statement stems from the fact that uh, there's two books that exist that relate to the same transaction, and that is the bank account, and the other one is the account at the bank. So what happens is that we have a business here that we call Handbags for Africa. They open a bank account in the general ledger of the business, and then the owner opens an account with the money bank in the name of the business, Handbags for Africa. So when the business is a bank account with money bank is going to keep records of money coming in and coming out of Handbags for Africa's bank account. And Handbags for Africa is also going to keep their own records of information to ensure that they are keeping track of the transactions that are coming out. So the Handbags for Africa people will be reporting on the business's perspective, and then the money bank people will be reporting on their own perspective as well. So if you understand these perspectives well, is that bank for the business is an asset. So when assets increase, they increase on credit, and when assets decrease, they decrease on the credit. Whereas for liabilities, the money that Handbags for Africa puts into the bank account for Money Bank, that is a liability to them, because once Handbags for Africa puts money into the bank account, it means that Money Bank now has a liability to return that money to Handbags for Africa when they want it. So they're going to keep a liability, and we know that liabilities increase on a credit and decrease on a debit. So whenever you have a debit entry in the bank account in the ledger, you should have a credit entry in the bank statement. So let us make an example in this case. So we're going to be talking about a capital contribution of 8,000. So let's say the owner of the business contributed capital into the bank account of the business in the amount of 8,000. So the bank account is increasing because now we have more money in the bank. So you're going to debit bank. You can see there the debit of bank by capital. And then after that, you're going to credit capital. The reason to credit capital is because capital is an equity account, and equity accounts increase on a credit. And then let us look at the perspective now of Money Bank. For Money Bank, this is a little bit different. So Money Bank obviously receives some money. So when someone receives money, now they hold an asset because they can use that money. So when uh, Money Bank receives that money from Handbags for Africa, they will debit cash, which is an asset, and then they will credit a liability, which is Handbags for Africa, because now that they're holding Handbags for Africa's money, they have an obligation to return that money. And then let's make another example. The other example is a purchase that is being made by Handbags for Africa using the money that they have in the bank. So the first thing that you're going to do, obviously, if they purchase a cell phone, the cell phone is an asset because it can be used for a period of time. So they're going to debit the cell phone because assets increase on the debit. Since they're spending money to buy the cell phone, they're going to have to credit bank account. So they're going to have to credit bank account because the bank account is decreasing. And then in the perspective of in the perspective of Money Bank, um, if they return 1,200 to Handbags for Africa, then they need to reduce their liability towards Handbags for Africa by 1,200 and liabilities that are used on the debit side. And also, since now they returned 1,200, it means that their cash position is decreasing by 1,200. So they're gonna credit cash by 1,200. So here we have just a small depiction of how a bank statement looks like and the way it works. So the first thing that you're going to have in the bank statement is the name of the business that Money Bank is recording on the point of view of. And then there's also going to be the balance. The balances will be updated after each and every transaction. So you can see there we have an opening balance of 6,096, and then we have a check 2910, and then the balance is then updated right after that transaction to 3,000. Sorry, is updated to 3,096. Sorry. Yeah, and you can see then after the deposit of 12,432, it gets updated again. And then on the debit side decreases what the bank owes to Handbags for Africa. And then the credit side, it increases what the bank owes to Handbags for Africa. And that is pretty much how a bank statement looks like. And then in this slide here, we have a general ledger, full-on general ledger of Handbags for Africa. And on the side here, we have a bank statement from Money Bank for Handbags for Africa. And we're going to be doing an example on this in the next lesson. So make sure you tune in. Cheers.